And since the debt problem isn't going away anytime soon, I don't think the macroeconomic problems or the currency problems or the bubble asset risks are going away anytime soon either. So we have to just, again, the facts haven't changed. They're just getting worse and worse. And so the themes stay the same for me. And we can unpack those at the individual level, but we're now trapped. We're trying as a country and as a nation and as a world hitting 400 trillion in debt in the next few years. That's literally like trying to swim with a cannonball strapped to your ankle. Growth is now, I think, mathematically impossible, whether you're reading David Hume from the 1750s, or Reinhardt and Rogoff, von Mises, or simple common sense from Ernest Hemingway, or even our own personal common sense, whether you're a family, a company, or a nation. When your debt levels are 3 times your income levels and you're strapped, I don't know how you can project growth optimistically, even in a political environment where there's a lot of optimism out there to get elected. I think the Fed, the White House, the Parliament, the ECB, et cetera, they're all trapped, and they're all desperately trying to reduce rates to save their bond market at the expense of their currency market. It's from China to the Swiss National Bank to the Bank of England to the Fed. We're just seeing a lot of desperate chickens squawking in the yard, pecking at each other, but getting really nowhere.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Matthew Piepenburg. Doesn't need any introduction. I think this is the 4th or 5th interview that we've done, so we've talked quite a bit, but he's a partner of von Greyerz AG. So Matt, thanks so much for coming on the podcast today.
Oh, great, Anthony. It's always good to speak, and lots to talk about as always too.
Yeah, agreed. And you were saying sort of before we got on that there's these trends that they sort of same trends every time we speak, but they just seem to be getting worse and worse. I'm sure we'll touch on that. But where I start with everyone, what is your current thoughts on the economy?
Yeah, I think, again, as we were talking before, the themes haven't really changed and the facts haven't changed. They've just gotten worse and worse. And, when the facts change, your opinions change. But right now, the key, look, everyone agrees now at this point that the key theme in the global economy or sovereign economies is unsustainable debt and what that does, and the ripple effects of what that debt does to every asset class, and certainly precious metals and currencies and credits and equities. So, we've just reached a point of the irrational, and I know that theme seems like beaten over and over, but the data just keeps getting worse and worse. And so you can't talk about the economy or even the markets, which are very dislocated from the economy. I mean, we've got recession now in Germany. I spent a lot of time in Germany. The mood, the facts, the data is pretty scary there. But, China's clearly on its knees as well. This is a interesting time for the UK and even the US. So, separating markets from the economy is important. Understanding the macro economy or the sovereign economy means understanding debt. And again, sometimes people throw data and facts out there, and it just becomes abstract when you're talking trillions or percentages. It's just important to keep in mind, in 1971, when we decoupled from the gold standard, I think the U.S. debt to GDP was just shy of 40%. I think it was 38%. And government public debt was 425 billion. And it didn't even pass trillion until we got into the Reagan era. But today that debt to GDP is at 125%, and public debt is 35 trillion and counting. You have to think about that. It's not just the extraordinary explosion in the debt, the exponential explosion. It's also the pace of it. It took us 220 years in the United States to get to 11 trillion in public debt. And in the last 4 years, we've added another 11 trillion in public debt. So again, these aren't meant to just be statistics that you throw out there to try and look clever. The ramifications are massive. And the Congressional Budget Office in the U.S. is already, projecting another, I think, 20 trillion in IOUs in the next 10 years. That's crazy. And we can talk about fiscal spending. I don't think it's going to come down that much. And in the next 3 years, we have to roll over about 15.5 trillion in U.S. Treasuries at a higher yield, despite the coupon being fixed at 2.3. The yields are around 5%. So the yields are double the sticker price. So where does that money come from to refinance these grotesque debt levels in just the U.S., which is the home of the world reserve currency and the tier one asset 10-year U.S. Treasury? You can't ignore the reality of what debt does to these economies and the ripple effects it has on currencies and markets. So when you just look at that and what that's done, everything starts there and everything ends there, whether we talk about currencies, precious metals, equities, credits. It all comes back to how that debt has central banks trapped, how that debt has the Fed trapped in particular, and what that means to the man on the street, what that means to the bottom 90% or even the top 10% in the wealth inequality spectrum. The inflationary effects of that, the currency debasement effects of that. And then if you just look at the raw numbers on recession data, whether it's bankruptcies, unemployment levels, U6 unemployment levels, debt-driven CPI growth, which is pretty anemic. It's not meant to be negative for negative sake, but I can't be possibly bullish right now. I don't know how anyone can. That doesn't mean markets can't continue to go up, but you're measuring it against a currency that's going down. So there's just so many overlapping themes, Anthony. But to make a long answer even longer, the debt really defines the global macro right now, and it defines all the asset classes that we discuss under it, and it even defines some of the geopolitical desperation we're seeing in the world. So, and since the debt problem isn't going away anytime soon, I don't think the macroeconomic problems or the currency problems or the bubble asset risks are going away anytime soon either. So we have to just, again, the facts haven't changed; they're just getting worse and worse, and so the themes stay the same for me. And we can unpack those at the individual level, but we're now trapped. We're trying as a country and as a nation and as a world hitting 400 trillion in debt in the next few years. That's literally like trying to swim with a cannonball strapped to your ankle. Growth is now, I think, mathematically impossible, whether you're reading David Hume from the 1750s or Reinhardt and Rogoff, von Mises, or simple common sense from Ernest Hemingway, or even our own personal common sense, whether you're a family, a company, or a nation. When your debt levels are 3 times your income levels and you're strapped, I don't know how you can project growth optimistically, even in a political environment where there's a lot of optimism out there to get elected. I think the Fed, the White House, the Parliament, the ECB, et cetera, they're all trapped, and they're all desperately trying to reduce rates to save their bond market at the expense of their currency market. It's from China to the Swiss National Bank to the Bank of England to the Fed. We're just seeing a lot of desperate chickens squawking in the yard, pecking at each other, but getting really nowhere.
Yeah, but so as you said, so much to unpack there.
So
a few different places I want to take it.
Yeah.
I probably disagree with you on the growth, because I think what
Mhm.
we're seeing, and this is something to do with maybe probably everything in life at the moment, it's concentration. We are seeing
Sure.
a mass concentration into these extremely large monopolistic businesses. Wealth as well accumulating to the similar people who own those assets. So it seems that it's actually more a stripping out of the middle class and the small businesses to the accumulation to the massively wealthy, because they're and the massive companies, because they're just so much more efficient, and they have the benefits of economies of scale. So it seems like that's really where the growth is coming from, at the expense of the rest of the economy.
No, look, it's great to disagree. It's great to unpack these topics. I mean, when you're talking about growth in certain stocks or certain sectors in the markets, it's undeniable. And of course, the NVIDIA example, despite some of its pullbacks, or the tech sector in general, or the AI memes and all that, or even GDP growth. Of course, you can't just be universally negative and say nothing's happening good or nothing's growing. To me, not to disagree, but let's go to the nuances of that a little bit more. Objectively, fiscal or deficit spending can give you stimulus. You can get growth. Rate cuts can give you growth in the equity markets. Rate cuts can help debt markets expand and give you a little juice, but they're long-term. I think they're long-term disastrous. And in terms of the growth that we're seeing, and even in you look at GDP, to me, debt-driven growth is an oxymoron. Debt is like steroids. You can get stronger from the steroids, but you get the muscle pains and you get the physical reactions later. Or a martini can give you a buzz growth, but you get the hangover later. I don't consider deficit spending or twin deficits in the U.S., for example, as a good sign of growth. Of course, you can borrow your way into more growth, but that just postpones an eventual hangover or an eventual currency devaluation or eventual risk in the credit markets. So we can extend and pretend, to Luke Roman's point, these markets could go on for another 5 years based on just more solving a debt problem with more debt paid for with debased currencies in some direct or indirect way from central bank policies. But that growth and that buying of time always gets a hangover at the end. It always gets paid off at the backs of the consumer and at the backs of, I think, the middle class more than anyone. But yes, you can have growth. Debt-based growth is growth, but it's false growth in my mind. And I think at the end of the day, as Luke said, this could go on for 5 years or could end Monday. There's so many different needles, whether they're geopolitical or monetary or social, um, that are pointing at this debt balloon that no one can really predict. What will it be? Will it be a banking crisis? Will it be a mean reversion in the equities market? Or will the S&P just be nationalized with more support from the Fed and it continue to grow higher? We can talk about that. But to me, growth based on extraordinary debt and extending and pretending and rolling over debt, I think one of the reasons Powell had to cut rates by 50 basis points is we do have 15.5 trillion in U.S. Treasuries that need to be refinanced the next 3 years. Higher for longer made that impossible. We had to bring it down because Uncle Sam couldn't afford U.S. Treasuries at those yield levels. And frankly, foreign investors or foreign debtors that are tied to dollar-denominated debt is trillions, over 13 trillion. If those rates are too high, they have to sell U.S. Treasuries just to get U.S. dollars to buy oil. And so that means a massive new supply of U.S. Treasuries into an already unloved market. When you have more supply of U.S. Treasuries into the market, that sends yields up. That's the real interest rate, not the Fed funds rate. And so then you have to print more money to control those yields and support those bonds. So it's just spinning and spinning and spinning. And yes, in the mix of all that nonsense, you can get shoots of growth. But growth based on debt, to me, at the levels of debt we're at now, there are normal levels of debt and there are irrational levels of debt. Growth at this point, at the debt levels that we talked about at the intro, is simply adding more kerosene to the Folgers can, and the matches around that can just continue to be the same and get worse. And again, no one can predict what match will light that can or whether we can just keep trying to postpone that implosion. And we can make an argument that we can take the MMT fantasy of the modern monetary theory, which I've said many times is neither modern nor monetary nor a theory. It's been tried in the 18th century. It's been tried in Yugoslavia in the 90s. It's been tried in the 20th century in Spain, Italy, and Weimar. It never works, but it buys time. It buys votes. It even buys the Nobel Prize for Bernanke. But it's temporary prosperity at the expense of permanent ruin through inflation of the currency. So, yeah, we can talk about growth. I disagree. I think, yes, empirically you can show nominal growth, but inflation adjusted real growth and then the kerosene to the debt pile that we already have just buys time. And we're all walking on very thin ice, whatever asset class we're looking at, except for I think hard assets. For this current environment, hard assets are, and particularly precious metals, despite my bias, are poised and positioned quite well.
Yeah, thanks for unpacking that. And I think, we can go into the weeds here maybe. And if I look at maybe other stock markets that have experienced large crashes, large stock markets recently, we look at Japan and China recently, rather than it being as much a government debt issue, it was a private debt issue of the companies that had balance sheet, basically, defaults. So I think there's the benefit of it being a government where they can print their own currency. But as you say, there's the risk there that they're going to completely depreciate it, similar to what we saw in 1930s or other periods of history.
Yeah, I mean, look. Obviously, August we had the Japan carry trade, and I thought it was a joke that Japan was like a prop desk for the West in general. You could arbitrage lower rates there, borrow in yen, convert it to dollars, speculate and arbitrage and lever in the S&P or the NASDAQ, and you could do it in Australia as well, because the yen was so cheap, and that worked because of that carry trade. I think the bigger carry trade is the US dollar. That also needs to be cheap. That's why we have to cut rates now, because higher rates and the higher cost of money slows everything down in a debt tailwind world economy, certainly a debt tailwind US economy. And so you can look at Fed policy, and to your point, you can look at the balance sheets of companies, or you can look at what happens in China. I mean, China's interesting for a lot of reasons. I mean, China, of course, just cut rates as well, like everybody else. China has so many problems, but they've got too many RMB loans, too many, yuan-based loans, and not enough banking reserves. And in addition to cutting rates, the People's Bank of China and the government of China, in addition to cutting rates, they're also cutting down the banking reserves from 18% to 15% to 10%. So there's less and less capital to back up those risks. And there's a lot of very risky loans, not just commercial real estate loans or residential loans on Chinese bank balance sheets. They're really sick banks. And if you listen to Thomas Hernig, former Kansas City Fed president, who's very blunt and much more honest than Powell, we have the same problem in the U.S. banks. they may be too big to fail, but they're too rotten to succeed in my mind, because we also have a similar case of, not only did we have 600 billion worth of really underwater US treasuries on bank balance sheets, but you had trillions of non-performing loans, and you still have them in commercial real estate in particular. So banks' capital to asset ratio, which is far more important than risk-weighted capital, which is nonsense, but their capital asset ratio is at 7%. If that goes to 4 or 5%, you have a real risk of bank failure. Too big to fail banks will always be bailed out in some direct or indirect way. Smaller banks may get smacked, and we're seeing their exposures. But those type of weaknesses in the banking sector, and those kind of weaknesses, those are very universal in major power company or major economic powers like China and the U.S. That's scary. To see Germany's exports, to see Germany's industry, to see Germany's inflation, to see Germany's recession standards. When you're seeing that at the same time that China's in trouble and the U.S. banking system, the Chinese banking system are in trouble, and we see the ECB and the PBOC and the Fed all cutting rates simultaneously, that's a scary indication, because cutting rates is always a sign of weakness and not strength. And you're seeing weakness globally now. I think that's what separates this current macro and market backdrop from even 2008, which was a contained crisis in subprime real estate, or MBS and the ABX trade and those mortgage-backed securities, and a real estate bubble. But China and Australia and other countries didn't. It wasn't a universal crash in 2008 like it is now. It wasn't universally sick. And in terms of the growth in the S&P or the Dow or the NASDAQ, I'm getting old now. I'm in my 50s. I was running a hedge fund during the dot-com bubble, and I won a lottery ticket on an IPO. I'm not proud of it. It was just pure luck. It wasn't genius, but you learn lessons that, the years teach things that days don't notice. And I remember Lucent. I remember Qualcomm. I remember Commerce One. I remember Microsoft. These weren't bad companies. They were grotesquely overvalued companies. What reminds me so much of that period of the dot-com bubble before it imploded, and luckily I got liquid before it did. That was also luck more than timing, although it did feel pretty lofty, pretty bubbly before February of 2000. But I think what I see very similar and even worse today in the markets today is you see a much more concentrated NASDAQ and S&P in terms of market cap, and a handful of names. It was the Magnificent Seven, then it was the Fabulous Five, now it's the Triumphant Trio. But you can't have a market that narrow. And I think that market, you can't predict when or if it will mean revert. But I think the things that you can predict is when net income margins in large companies like NVIDIA go from north to south. You just have to look at their net income margins. We saw the same thing in the NASDAQ crash in 2000, 2001 that lasted and then eventually became an 80% net peak to trough loss. What I learned from that is I wasn't looking at momentum, although that's important. I was looking at the net income margins. And when they start going from sustainable, when you have price and cost and volume advantages, which NVIDIA and Lucent and at the time Microsoft had or Amazon had, that can be a wonderful ride up. But when you see those net income margins go from north to starting to trend down, then you see a sell-off, and markets sell faster, or they sell off and they fall faster than they rise. And so I think you have to look at the net income margins on the few names that are sustaining this U.S. stock market. Yes, there's growth, but it's led by a handful of names that are not bad companies, just grotesquely overvalued companies. And again, that's not a gold bug, gloom and doom kind of prejudice. Even Jeremy Grantham at GMO, a fund that I invested in years ago and I still respect. I mean, he's an equity god for a reason. Druckenmiller and these others, and Paul Tudor Jones, these are very smart guys. But the market to them is shockingly overvalued. You've got, I think, PE ratios now at 34. That's not all-time highs, but it's scary to see that in a market led by a few names. You've got an S&P index that trades it's 7 times the global market index. So there's a massive concentration of money in a U.S. market that's led by a few names that cannot sustain net income forever, not forever. So it's not a question of that will end in 6 days or 6 weeks. That will end when the signals from the balance sheets tell you so. And I think, markets are very Pavlovian. When the Fed is dovish, they'll go up. When the Fed is hawkish, they'll go down. That's what we have because we have a centralized equity market today. It's distorted completely by Fed support. And as we saw in 2022, The markets tanked in 2022 because Powell was very hawkish, openly, forwardly, guidingly so. And so we saw the worst nominal returns in stocks and bonds since 1871. It wasn't a coincidence. It was a hawkish Fed. It was taking away the punch bowl. It was raising rates. It was making the cost of debt and stock buybacks and rollovers much more expensive. So what did the markets do? Of course they panicked and they went down. In 2023 and this year, markets have been going up, not because rates were going down, because the Fed was talking about a rate cut and the markets priced that in, and we just got a rate cut. But for almost 2 years, just the talk of Fed rate cuts sustained the markets out of those 2022 lows and got the markets all excited again, like little children in a candy store. It's a momentum market, Pavlovian market, based on what Papa Fed or Mama Fed says to the little spoiled nephews on Wall Street. If we're going to be dovish, or we're promising to be dovish, or we're looking to be dovish, markets will go up. And you could make the case that since America is on its knees in debt, that we almost need to nationalize the S&P or the NASDAQ because we need the tax receipts. And so you could argue that the Fed, the fourth branch of government, will be very generous going forward. And that despite all the macroeconomic and recession indicators in the U.S. and elsewhere in the world, that they'll do whatever it takes to sustain this market. And they'll keep rates low and go lower. And they'll keep this bubble and this airbag under this otherwise very overvalued, broken, narrow S&P and NASDAQ. They'll keep it alive. But even if that were to happen, and there's still massive sigma risks and mean reversion in the market, but even if they sustain that market and you get a 20% return or a 15% return on the S&P, you're measuring that in a currency that's lost 25% of its value in just the last 4 to 5 years. So as I keep saying, you're running uphill in roller skates in terms of real return versus nominal return, because we're buying the temporary prosperity by these political opportunists, as Hemingway said, at the expense of permanent ruin, which is inflation and war, which we're looking at a world now that's highly inflationary and very much on the brink of war in whatever corner of the map you put a needle on or put a pin in. So again, it's not meant to be negative, but these trends are pretty obvious. I think it's a very narrow market. I think it's a very Fed-supported market. I think it's a very Fed-driven, centralized market. Again, I don't think the companies that are leading this market are necessarily bad companies, but they're very overvalued companies. And sadly, I've seen this movie before. And again, I can't predict the day or the month that they mean revert, but I can predict the signals that will indicate it. And that will be these net income margins. And I also think you have to look at, I use the Harvard metaphor. You know, Harvard has a $60 billion endowment, but they're illiquid because a lot of their money is in private credit pools or private equity deals that aren't marked to market, but are marked to a fantasy book that if you look under the hood of the actual valuations of those very illiquid investments, which keep the balance sheet looking nice for, you know, board member or board meetings or annual reviews. But if you actually need liquidity, you actually need capital, it's not there. And in fact, those assets are losing value and they're very dangerous assets. It just takes a little forensic accounting and balance sheet and financial statements to see that Harvard may have 60 billion on paper, but they don't have liquidity and they don't have strength. And again, that's just an example. Harvard University, which has a pretty smart investment committee, but they're very reminiscent and they're very metaphorical and they're very indicative of what other institutional smart guys or family offices are doing. They're buying time on the paper by having illiquid investments that are marked to nothing but the book value of an accountant, not the actual market value of the underlying assets. I think that's another dangerous indicator. A very illiquid private equity private credit pool, which I think even Gundlach says are the new weapons of mass destruction. They're absolute trash, these private credit pools, and they're everywhere. And I think when you combine that with a very narrow equities market and a credit market that was under a lot of pressure under higher for longer, getting a little bit of release right now with lower rates. But again, even the bond market's only being saved at the expense of the US dollar. So around and round we go. And even if we can get sustained S&P returns or NASDAQ returns, I think most investors are missing the obvious fact that even if you're getting, despite the risks in this highly overvalued market, even if you're getting a positive nominal return measured in real terms and not the CPI scale, measured in the actual purchasing power of your dollar, you're losing or you're barely breaking even. So again, I'm a precious metal guy now for a number of reasons, but I'm very, very aware of risk asset markets. That's how I came up. And I came up as a speculator. I'm not against speculating. You need to be very careful when you're only looking at the reward. Investors have to be aware of the risk. And even if you get just the reward side on the S&P or the NASDAQ or the Dow, you're still measuring that in currencies that I said It's like Bergschnee and Frühling, we say in Switzerland. It's just melting like snow in the spring. And that's not sensational. That's a fact. We are losing the purchasing power of our dollar. And that conversation isn't being had as it should be, whether it's in political debates or the Wall Street Journal, or the New York Times. It's omitted for a reason, because it's embarrassing. And if you really understood real returns and not just what the BLS tells you as a CPI scale and the compounding effect of that, you'll be scratching your head. You'll be aware that, boy, even if things go all right and we optimize and project a market that never reverts, you're still getting that at the expense of your currency, which is why, sadly, precious metals for me is no longer a gold bug kind of a bias. It's just common sense to me right now.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Yeah, so you mentioned there the devaluation of the dollar. I think it was 20-25% over the past 4 years. So how do you calculate that? Is that looking at liquidity? Is that looking at inflation? Sort of what do you do to see the
because the inflation rate is a rate of change, not a price level change. So if you go from, and again, this is, by the way, this is just assuming you believe the official CPI scale. I mean, again, which I don't. And Larry Summers to John Williams, it made that clear that the reported inflation, the CPI official number, it's never right, but it's always correct because it's the official number. But as I've joked many times, it's as bogus as a 42nd Street Rolex. I mean, everyone knows that. But even if you assume that the CPI scale is accurate, which is a very, I think, open secret from Wall Street to Brussels, but even if you assume that the CPI scale is accurate, again, it's a rate of change, not a price level change. So if you go from 9% at the highs, and then you go down to 6, or you get to 3, but if you go over if you do that over the last 3 to 4 or 5 years, that's a compounding effect. That means you're losing purchasing power year after year after year. And that is, again, just assuming that the CPI scale is correct. So going from 9% to even 3% inflation isn't a victory over inflation. It's just cutting down that rate of change. But in the last 4 years, those prices have added up. And again, anyone can feel that. Rich or poor, top 10, bottom 90, whatever, we all feel it. It's absolutely obvious. And again, it's the classic: go to the grocery store, go to the, cross the GW Bridge, buy a plane ticket, pay your kids' tuition, pay rent, whatever, buy furniture. Everything costs more, and the purchasing power of your dollar is palpable. But again, that compounds you. If you're just like, never underestimate the power of compounding returns, as Buffett famously said. Don't ignore the dangers of compounding losses through inflation, that invisible tax, which again is just theft. And as I've said so many times, that hurts everyone. It is an invisible tax. It's absolutely fatal to the working poor, which is the U.S. middle class. And it's the same, I think, more so in the U.S. than other parts of the world, but certainly inflation in the U.K. and in Germany and other places is being palpably felt. But when you add that invisible tax of inflation, or the debasement of your currency, with then rising rates, which we've had for the last many years, a couple of years, when you add that rising rates to an invisible tax to then actual income tax, what are you left at the end of the year with? Very little actual free capital with real purchasing power. And I think that's why we have so much unrest, so many problems politically and socially in the U.S. beyond just identity politics. We have a country that's strapped, that's broke, and the people feel it, and people feel things with pain. They react in different ways: left, right, center, woke, based, however, but there's a lot of disunity. And so that's where I see that, to answer your question, that lack of purchasing power. And again, you can take a guy like Eric Weinstein, or you can take a guy like Jeremy Grantham, or you can take Jeffrey Gundlach in the bond and credit markets, or intellectuals. We all see this. But you can take a guy like Oliver Anthony, a singer in Farmville, Virginia, who plays guitar, who doesn't know anything about, NBA level statistics, and doesn't need to, because as he said in his song, which has 80, 90 million hits in the US for a reason, my dollar ain't worth crap, euphemism, and I'm being taxed to no end. That's the cry of the middle class. That's the cry of common sense, which is completely complementary to the data points that we're looking at if you look beyond just nominal returns or projections in a handful of a few names. So again, it can be an echo chamber of just trying to be negative for negative sake. Certainly I've gone long and short a lot of stocks that I thought were pure momentum trades, but I didn't believe in their fundamentals. I'm still very nervous about the sigma moves on these equity markets, but you can make a case that they'll keep going up if the Fed wants to just make them a nationalized 401k for tax receipts for a debt-soaked America. But even if the markets are sustained by a Fed airbag and low rates and more QE, direct or indirect, it will only be a gain at the expense of your purchasing power. And you can say equities are one way to hedge against the lack of purchasing power, the declining purchasing power of your currency. You can, but that's assuming that equities only go up and to the right. I think precious metals are a far better way to insure against that risk, especially now. But that's also assuming that equities don't have a mean reversion moment. And I've never seen a market bubble that didn't pop. But that's debatable to some, but I think this is no exception in history. And even gold, by the way, gold doesn't go in a straight line. Gold's had a couple bad years where it's lost, but it doesn't. The trend in the direction it's going now, and the macro backdrop of debt and de-dollarization and distrust in the U.S. Treasury based on a weaponized dollar, et cetera, and the oil trades and the BRICS rise, these are all coming together to suggest not only that the dollar's getting weak from those signals, but because the U.S., Jake Sullivan and Janet Yellen, even Harris and Trump are all talking about needing a weaker dollar. We need a weaker dollar. We need negative real rates. We need to inflate our way out of debt. And we'll do that at the expense of the purchasing power of the dollar you measure your portfolio, your checking account, or your 401k with. And again, this is not sensational. This is fact. These are objective facts to me. And how you interpret those facts, whether it's optimistic or pessimistic, is up to each of us to do. But for me, sadly, as I've said many times, I'm no fun at a Christmas party or a cocktail party because I don't look at it very optimistically. And I don't see an easy way out, regardless of who's elected next in the parliament in Germany, France, or at the White House. It's, as I've joked many times, if I were the next president, it's like being the captain of the Titanic after you've hit the iceberg. Santa Claus, Mother Teresa, Harris, Trump, I don't think it's going to be an easy fix. And I think investors and citizens need to be aware of that.
Yeah, and I know Yellen has talked about having to bring the deficit down and sort of, I don't know if she mentioned 30 for some reason that's coming to my mind, but I know we chatted about that before, and you don't think that's very likely.
Well, look, it's a wonderful thing to say during an election cycle. It's a wonderful thing to finally, when the goose is already cooked, to say we're going to try and save the goose. I mean, as always, the state, the Treasury Department, and the Fed are so behind the curve of reality, and they're politicians. The Fed is now a fourth branch of government. It's an almost grotesque coincidence. The former Fed chairwoman is now the head of the U.S. Treasury Department. It's such an embedded administrative bureaucratic nightmare of incompetence and a sustained level of mediocrity. But they're always too late to the party in admitting responsibility or admitting a problem. Janet Yellen could say we're going to cut deficit spending. Great, but how? How are we going to? Who's going to buy our U.S. Treasuries? By the way, before we even get into fiscal spending and a twin deficit with budget and trade. These things are not curable in 4 minutes or 4 years. But even before you even get to the fantasy of cutting deficit spending, who's going to buy Uncle Sam's IOUs? The world is net dumping U.S. Treasuries and net stacking physical gold for a reason. China and Japan, traditional big buyers of U.S. Treasuries, are net sellers or selling U.S. Treasuries right now. Why? For a number of reasons, all of which we could spend 45 minutes on. But that's just the simple math. There's less and less love for an IOU from an issuer, the Uncle Sam, who's totally discredited after weaponizing the U.S. Treasury and the world reserve currency, totally discredited for the weaponization policies, and totally discredited because he's issuing an IOU, which is a declining asset from a bankrupt issuer. Even the U.S., despite its world reserve currency status, is known throughout the world as getting weaker and less strong. So less buyers of U.S. Treasuries means we're going to have to create synthetic liquidity to pay for or monetize our own debts. That's just on the U.S. Treasury side. If you get to Yellen or any politician who says they're going to cut spending, you're going to have at least 40 to 50% spending cuts in entitlements, which is Medicaid, Social Security, et cetera, or you're going to have to cut the military budget by 40 to 50%. I don't see that happening. I don't. We could speculate on whether that's going to happen. It's very hard to get elected if you say you're going to do that. You could try and do that. I don't think the population wants to accept that type of austerity because they don't trust who's ever going to be elected next, because 50% of the country is not going to trust who's ever elected next anyway. It's a desperate time. And I think desperate times are throughout history, and without exception, desperate times require desperate measures. And the most obvious measure, again, is debasing the currency to inflate your way out of debt. And the other classic measure is to distract your country in unnecessary wars, to blame the inflation or scapegoat the inflation on those wars. And I hope that's not the option. I hope it's just currency debasement. But I think, there's no exception when a country's against against the wall in debt. It will debase the currency, and that explains why physical gold's at all-time highs, and that explains why the BIS has made gold a tier 1 asset as of last year. That explains why the oil trade is slowly moving away from the petrodollar and being net settled in gold. That explains why 30 countries are repatriating their gold off the COMEX and London exchanges to have gold at home and to repatriate their gold. That explains why 45 BRICS nations are trading outside of the US dollar and the numbers increasing. That explains why the Gulf oil states are talking more and more to China about selling energy outside of the US dollar. All these things, it explains why Eastern central banks have been buying gold net and selling US Treasuries net since 2014. They're playing the direction of the ball, or the hockey puck, or as I say, the polo ball. You can be going 35 miles down the field. When you see a backswing, you turn your horse and you prepare. Or when you see a hockey puck moving direction, you change your skates. What I see in the West is everyone standing around that polo ball or that hockey puck, and they're staring at it. Well, in the East and in the BRICS, they're moving in the direction of the ball. They're moving in the direction of history. It's hard to see that history when you're in it. It's not the end of the U.S. dollar's world reserve currency. It's not the end of America. It's the dollar will not be replaced. It will be repriced. And the U.S. Treasury is not trusted the way it was trusted even 4 or 5 years ago. And the petrodollar isn't what it was 2 or 3 years ago, since we weaponized the U.S. dollar. And America isn't what it used to be for so many reasons 5 or 10 years ago. So, and economically, socially, its foreign policy, its domestic policy, its debt policy, its immigration policy, it's just not the same. Whatever view you want to take, left or right, that's up to you. But we can all agree that it's not the same. It's not as trusted. It's not as strong, empirically and objectively. And so history is changing. The world is moving from west to east, not just in trade and in currencies and precious metals, but in policies. And again, it's not to say that I'm pro-Putin or pro-China. And China, as we opened, has a lot of problems too. It's got real risks. So I'm not saying that they've got it all figured out. But I am saying I think the West is in a period of severe cognitive dissonance on recognizing this. Even America, like other great empires, doesn't end. It just gets weaker and less credible. And that's clearly the case. I'm an American who spent half of my life overseas. I think that gives me a different perspective of America. I'm as patriotic as anyone, but I'm more objective. And I certainly see the opinions from Singapore to South Africa to North Africa to Brussels and Berlin or Paris or Rome. I have these conversations, and America isn't is respected financially, politically, as it was even 5 or 10 years ago. And our U.S. Treasury and our U.S. dollar is not respected or revered, but it is still the currency of liquidity. It is still the currency of FX exchanges. It is still a very king currency for liquidity, but as a strategic reserve asset, it's not a gold bug bias to just confess, as we're seeing, that the world wants to save in gold and spend in local fiat money. And that fiat money in every fiat currency is getting weaker compared to gold, and it has been since 1971 at a remarkable rate. So again, it's just understanding the connection of debt. It's understanding the connection of credit markets, currency markets, and precious metal markets and hard asset markets. And we are in, not going into, but we are already in an historical turning point where the world wants to save in something outside of a fiat currency system. It doesn't mean there's going to be a return to a gold-backed currency system. We can net settle in gold without having a BRICS gold-backed currency or gold-backed US dollar. But even the IMF, when they talk about their horrific central bank digital currency policies, which they started to signal and telegraph during the COVID hysteria, because corrupt regimes and corrupt banks always wait for a crisis to kind of toe dip into another stupid idea. But even central bank digital currency, which is highly insulting to personal property and privacy rights, despite how insulting that is, even the IMF knows that for a central bank digital currency to have any credibility, it has to be backed by a hard asset, it has to have some partial coverage, and that's obviously going to be gold. So again, people say this is gold bug biasing. It's just the direction of the hockey puck right now, and it's hard to see when you're just staring at it on the ice. But if you step back, you can see the direction. And I think the East and the BRICS countries, despite many of their flaws, and certainly China and Russia have concerns, they're playing the chess game. They're seeing the direction of the hockey puck and the ball, and they're moving in that direction. And the West is stubbornly trying to defend an old system that is breaking down.
Yeah, and do you think that's why we maybe haven't heard as much about gold and silver, even though they've had quite positive returns over the past year or so? Because the East is buying all of it, and the West is sort of selling.
Well, as a lot of the Bitcoiners I've listened to, I'm fascinated by their conversation. One of the compelling points they have is, if we've ever really done an audit of gold, how much gold does America or China or Russia or India or et cetera really have? Because if gold is the new direction as a reserve asset, he who has the most gold wins. I think it's fairly agreed that the World Gold Council's tonnage requirements or tonnage estimates for China versus the U.S. are completely wrong. But regardless of that, the question, why is gold omitted from the headlines? I think it's intentionally omitted for political and financial reasons. There's a great book, 6 Days in August, about when we went off the gold standard, and Kissinger and the central banks and the president were all sitting around at the Fed or the White House. And what was the big question? Where's the gold price? Where's the gold price? Because when we decoupled from gold, our currency became a spoiled kid at a frat party. We could create as much of it as we wanted to keep governments in power and to keep people reelected like Nixon. So when we debased the dollar and insulted our trade partners with a currency that was once backed by gold since 1944 and then went off that standard, our biggest fear was, will the gold price go too high? Because a rising gold price is a screaming red neon flashing indicator that your currency is losing purchasing power. So in 1971, that was a big concern, which is no coincidence why within a few years of going off the gold standard, we got onto the petrodollar system to create global demand for oil in US dollars. That gave the dollar strength that it lost when it decoupled from gold. And again, we could spend hours on that. But yes, the reason today you don't hear gold discussed in any Fed meeting or really any congressional or Senate hearing when they're talking to Yellen or Powell, and why it's not even really discussed in a presidential debate or on the Financial Times or in the New York Times or the Wall Street Journal. It's not that there's a bunch of geniuses at the mass media or in the fourth estate with geniuses at the Treasury Department and geniuses at the Fed and the bank getting together and conspiring. But it's just a natural known fact that we don't talk about gold because it's against our national interests to see gold rise too high too fast, because that's just saying that your dollar, your world reserve currency, has less and less meat behind its bones, less and less bite to its bark, and the world knows that, and the Fed knows that. So politically, it's embarrassing to talk about gold because it's a confession that your monetary policies are failing, that your war on inflation has failed. I mean, we just cut rates before we hit target 2% inflation. We lost the war on inflation, and we can talk about how that's not going to get any better anytime soon. But we don't want to talk about it openly and admit the failure of our monetary policy, so we don't talk about gold. And that's, to me, very deliberate. And commercial banks don't talk about gold because after the repeal of Glass-Steagall, when we made commercial banks effectively hedge funds with depositor money and leverage, gold isn't big business for the banks. They'd rather lever credit instruments. They can't lever gold the way they can other asset classes. And they don't really make money in storing gold. And they don't want to talk about gold because I do think there's a direct reason that the too big to fail banks, the Fed and the White House, all understand overtly and covertly that we don't want to talk about gold. And yet gold in the last 20 years, you pick your statistical window, but gold has outperformed the treasuries. It's outperformed the stock market. It has a much better Sharpe ratio, et cetera, et cetera. Even if you were completely ignorant to the macro policies or the larger understanding of gold as a reserve asset or as a wealth preservation asset, because it's not really an investment, it's a store of value. Even if you take that all out, if you just looked at its performance, you could discuss it like you could any other asset class, but we don't, and they don't. And there's a reason. And I think it is very deliberate. And again, we could spend hours on why. It's not tinfoil-headed conspiracy theory. It's being contrarian with an informed basis. And again, informed contrarians include guys like Paul Tudor Jones or Jeremy Grantham or Ronnie Sturfula or Larry Lepard, even people in the Bitcoin camp. We all understand that gold is a true store of value. And it's not a get-rich asset, it's a stay-rich asset. And the more you understand that, the more you can get over your cynicism about people talking about precious metals just because they're talking in their book. And I get that. I mean, I was the head of a family office for many years. We had a lot of money to allocate, and I sat across 100 desks from 100 salesmen projecting whether it was multi-strat credit funds or whether it was risk long short credit funds or private equity funds or private credit pool funds or SPACs or REITs. I've sat on the side of so many sell-siders telling you what they're going to project. And I have a cynical eye, or what Hemingway would describe as a BS detector. With precious metals, I don't have that same cynicism. That almost scares me, how much confidence I have in precious metals. But I think I understand people's cynicism when someone from a Swiss gold company, which is the strongest Swiss gold provider outside the commercial banking system in the world, with clients in 90 countries, I can understand why you think what I'm saying is biased to sell my book. I get it. But I think the arguments are now pretty objective to everyone. It's certainly objective to the central banks of the world, in the East in particular. It's certainly pretty objective to the Bank of International Settlements, of which I'm no fan. I'm no fan of the BIS or the people working for it or running it. But I have to understand, you have to agree why they made it a tier one asset, why they made physical gold a tier one asset. You can't ignore that. You can't ignore why the IMF, even with their CBDC, wants to cover that in gold, because it is a store of value. And you can't ignore the fact that, because there's been such an intentional omission of the discussion of gold from corrupted central banks, from corrupted monetary policies, and from corrupted commercial banking systems, you can't deny, despite all of that omission, the direction of it is where it is. But because it's so misunderstood, intentionally ignored, it only makes up about 0.5% right now of global allocations, which is fascinating to me, because the 40-year mean of physical gold allocations is really 2%, and it can go as high as 4 or 5%. But if we just mean revert, and believe me, the macro backdrop is so perfect for a mean reversion in gold. But if you just mean revert to 2% allocations, that sets the demand up by 5x, 4x, 5x. So again, depending whether you get 2%, 4%, but gold's going to double in price just on supply and demand mean reversion forces, not to mention all the other arguments about currency debasement and a new world going away from US IOUs, not replacing them, just repricing them. The tailwinds for gold are literally everywhere. And so, it's intentionally misunderstood. It's deliberately misunderstood. It's deliberately admitted. And yet, again, we have clients from 90 countries. Our minimums are very high. They're very smart people. They don't necessarily believe in nothing, but they trust their governments less and less. They rather save their money in gold and convert it to fiat money when they need to buy something, which, by the way, is exactly what the central banks of the East are doing as well. It's what the BRICS countries are going to do as well. They're going to use gold as a strategic asset, as a reserve asset. And again, the dollar or the peso or the yuan or the Swiss franc or the euro can be used for liquidity when you want to buy something at hopefully a much higher valuation vis-a-vis gold. It just makes so much common sense. And gold doesn't have to go up in a straight line to save its purchasing power, hold its value far better than any fiat money. And since 1971, all the major currencies of the world have lost greater than 95% of their purchasing power against gold. That should be a headline. That should be discussed everywhere. And yet all you'll hear in the news or the media is, well, in 2013 and 2015, gold lost 28% or 12%, So gold's not a safe asset. Oh, come on. I mean, come on. The overall trend is so obvious. I mean, Bitcoin, with all due respect, has had 80% or higher drawdowns. That's volatility. Its standard deviation is 155%. You could say whatever you want about Bitcoin. It's certainly a better annualized return than gold, but its standard deviation is off the charts. It's not a store of value. It is a XXX levered, triple Q levered tech stock. And again, great, speculate as you will. I've certainly speculated in more riskier stocks than Bitcoin. But don't consider that a reserve asset. Don't consider that a store of value now or anytime in the future. But gold is, which is why, again, with all due respect to cryptos or digital gold, central banks aren't buying digital gold. They're buying physical gold. And I'm not a fan of central banks, and I can't believe I'm saying this, but look what they're doing, and there's a reason for it. They're following that hockey puck in the new direction, and a lot of Western investors uh, aren't seeing it, or frankly don't care, because they'd rather chase rate of return in Nvidia and assume that that's a better store of value, or a better way to fight against inflation, or a better way to get rich. That's a personal choice for everyone to make. For me, at this market, at this top, I still believe in what my father and grandfather taught me: buy low and sell high. What we're seeing is everyone doing the opposite. I would not be chasing these tops with any vigor, certainly not with any leverage and any margin accounts. But yeah, they can still go higher, but their nominal returns will be eaten alive by their real returns. And I think that's the elephant in the room that most people just don't want to see. They just don't want to see it.
Yep. So Matt, thanks so much for your time today. We've gone so many different places, and as you said, unfortunately, I think we have to talk tens of hours to get to the bottom of all these things. Maybe one day we'll have to do that. But my last question is, what is one message you'd like people to take away from our conversation?
Same message I always say. Again, I really mean this sincerely. You don't have to take my view on precious metals. You don't. We're on Bitcoin or anything else. Like I said, I think, there's something, as John Kennedy said, immoral about abandoning your own judgment. I really invite people to understand sound money and take their own opinions on it, understand central bank policy, get informed. But if you're going to stick to your own judgment, just make that judgment more informed. I disagree a lot with Brent Johnson on the direction of the DXY, but he has a lot of strong points, and he could be right. You should challenge my view on the dollar with someone like Brent Johnson. You should challenge my view on Bitcoin. I'd like to spend hours talking about Bitcoin versus gold, not because I'm mocking it, but Larry Leopard, someone whose macro view I respect and whose Bitcoin view has a lot of compelling arguments. It's very different than mine. My point is only, whether it's Brent Johnson or Larry Leopard, Grant Williams or me or Ronnie Sturfeld talking about gold, or you could take stock market bulls and stock market bears. My advice is to get informed and look at both sides of every argument, not just mine. I am admittedly very, very negative and admittedly very contrarian, but that's done well for me. But I'm not asking people to just look at my worldview. I am saying, get a balanced view, though. Challenge yourself, whatever view you have. Look at the other side and draw your own conclusions, because the facts that we've talked about today with debt and currency and IOU markets and treasury markets, those are obvious. What they're not is openly discussed in any kind of constructive way in the mainstream financial media or in political discourse today. And I think it's up to all of us to get informed and use our own judgment. Just make that judgment based more than on emotion or bias as much as you can. We're all biased, but I think facts are stubborn things. We can interpret them differently, but please stick to the facts when you're making decisions rather than projections.
Yep, great point. So, Matt, thanks again. If anyone wanted to find out more about your work, where would the best places for that be?
We're von Greyerz.gold or vg.gold. That talks a lot about our services for gold investors, but there's also a ton of free education on why gold and how to own gold, how not to own gold, looking at different jurisdiction choices, looking at private vaults versus commercial banks, physical gold versus ETF gold. There's a lot of free education there. And, it's certainly where all of my articles and interviews are. And obviously my partner, Egon von Greyerz, who's iconic in the space and a great mentor and a great partner. All of his articles and interviews are there as well. So it's a great place to stop and toe dip into understanding precious metals.
Great. I'll put that in the description, but thanks again for your time.
Thank you, Anthony. Always a pleasure.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right. Thanks again.